Welcome to the deep dive. Today we are landing squarely in, well, the very complex and high-stakes world of Asia-Pacific real estate,
And specifically Hong Kong.
specifically Hong Kong, where there's this chronic pressure for flexible, quality housing, and it's driving some massive shifts in the property market.
That's right. Hong Kong is, it's a perfect laboratory for seeing how real structural necessity creates market innovation.
And we're tracking one company in particular, Weave Living.
Exactly. They've found what looks like a brilliant high-speed solution to the city's housing supply issue,
Which is,
turning underutilized hotels into long-term rental apartments. And look, this is much more than just repurposing buildings. It's a strategic move that injects stable housing supply into a hyper-dense city, and fast.
so that's our mission today. We need to extract the critical insights here. We have to understand the strategy. How is Weave Living managing this incredibly rapid expansion?
And what's the real difference between the rental products they're offering now? It's not all the same.
And crucially, why are powerful institutional investors suddenly pouring, billions into this specific conversion model? This is all about strategic growth, speed to market.
And really, the future of housing in these big global financial hubs, it forces you to look beyond that traditional split between residential and commercial real estate.
How so?
Well, when you have this massive influx of professionals, entrepreneurs, corporate teams, they need housing for maybe 3, 6, 9 months.
Right, not a standard 2-year lease.
Exactly. They need something flexible, furnished, and a traditional apartment lease just doesn't offer that. Weave Living is bridging that gap.
So our goal is to understand how these hotel conversions are becoming maybe the necessary immediate solution for these kinds of extended stay needs in Hong Kong.
It's a fascinating case study.
Okay, let's unpack this.
Yeah.
And let's start with the sheer scale of their expansion plans, because this isn't some cautious pilot program.
Oh no, this is full throttle. Aggressive doesn't quite cover it. Their approach shows absolute confidence in the long-term demand for quality rental housing.
And it seems to outweigh any short-term cycles in the hospitality sector.
For sure. They are leveraging an opportunity that popped up when a lot of these assets became available during the recent market correction.
So we know Weave Living is reportedly in deep discussions right now for 2 pretty massive hotel acquisitions in Kowloon.
And these would alter their portfolio almost overnight. These are substantial properties.
Let's put some numbers on it. There's the 598-room Hotel Kuzi Harborview,
Which is huge.
and the 99-room Hotel Ease Mongkok.
So let's just think about the strategic implication of those numbers for a second. If those 2 deals close, you're looking at an addition of 797 rooms.
Nearly 800 units?
Right. And that's being added to their existing portfolio, which sits at around 1,500 rooms across both Hong Kong and Singapore.
That's a huge jump. It's almost a 50% increase in inventory from what is essentially one single strategic move.
It is.
But why is acquisition so much more strategic than, say, traditional real estate development?
The core insight here, it's all about speed to market. Securing nearly 800 rooms through conversion means you completely bypass the agonizing years-long process of land acquisition, zoning, new construction.
All the red tape.
All of it. They're acquiring structures that are already built, they're already zoned for high occupancy, they have elevators, fire systems, utilities. The model lets them inject supply into the rental market years faster than a traditional developer ever could.
So they're tapping into this ready-made building stock, a sort of shadow inventory.
That's a good way to put it.
Okay, so what's fascinating here is that this aggressive pace, this idea of repurposing hotels for residential use, it's not an anomaly. It's not just this one company.
Exactly. It reflects a much broader institutional revival of interest in Hong Kong's hospitality assets for conversion. The market itself confirms the momentum.
Oh, so.
Well, we saw total transactions in this specific sector hit HK $3.2 billion in just the third quarter of 2022.
$3.2 billion. That kind of capital flowing in, it's the ultimate proof that the financial world sees this as a durable, long-term trend, right? Not just a temporary blip.
100%. It's a calculated bet that the demand for mid to long-term flexible rentals is a safer bet than, say, relying on volatile tourism numbers.
They're buying the infrastructure and just recalibrating its purpose.
And that infrastructure is ideal for the target demographic. It's perfect for those professionals who need fully furnished, flexible options, serviced apartments, these serviced rental solutions.
It gives them the amenities of a hotel with the space of an actual residence.
Precisely.
Right. But let's shift to the product mix. Because Weave Living, when they first came on the scene, They're really known for co-living.
That was their brand.
But if you're securing almost 800 new rooms, you have to appeal to more than just young, single professionals who want communal spaces. So how are they managing that strategic diversification?
This is a really crucial strategic shift for them. It's driven by both market reach and, I think, investor appeal. They are deliberately moving away from being defined just by co-living.
To become this broader, weave living brand.
Right, encompassing multiple segments of the rental market.
So what exactly is the core product they're pushing now, beyond that traditional co-living model?
They're expanding into two major categories. You've got your traditional multifamily rental units, and then you have high-quality serviced apartments. And that service apartment model, that's the perfect bridge.
Okay, so we hear this term extended stay solutions a lot. For you listening, trying to picture this, how does a service department really differ from just booking a hotel for a month or signing a normal lease?
That's a key distinction. The sweet spot is typically stays from, say, 3 to 9 months.
Okay.
Unlike a traditional apartment, it comes fully furnished. It often includes weekly housekeeping, utilities, Wi-Fi, all bundled into one monthly fee.
So no hassle.
Zero hassle. And unlike a hotel, you usually get a larger unit with a kitchen or kitchenette. Much more independence. For a corporate transferee or a consultant on a long project, that immediate setup is invaluable.
And we can actually see this diversification in their portfolio. They acquired a property at 6 State Hospital Road in Mid-Levels. What does that particular acquisition tell us?
That one is highly significant because it's being refitted as their first purely traditional multifamily rental apartment property.
So no co-living aspect at all.
None. It's a clear signal that they're ready to offer standard multi-year leases on unfurnished or semi-furnished units. They're moving way beyond being a niche operator. They want to cover the full spectrum of housing needs.
But wait, if they're running co-living, serviced apartments, and traditional multifamily all at once, doesn't that create a serious operational challenge?
Oh, absolutely.
I mean, servicing a co-living property with its communal events is very different from managing maintenance requests for a traditional tenant.
It absolutely raises the operational complexity. But that complexity is what's necessary to unlock the institutional capital.
How so?
While co-living can generate high revenue per square foot, big institutional investors, they tend to prefer the operational simplicity and the established valuation metrics of traditional multifamily housing.
It's what they know.
It's what they know. So by diversifying, Weave Living positions itself as a key provider of adaptable housing solutions. They can shift assets based on market cycles, but they still hold solid traditional assets that appeal to the big funds.
That flexibility really is the genius of it. It makes them a much more palatable investment for like a pension fund or a large asset manager.
Exactly. They are de-risking the portfolio by moving beyond a single niche. They're becoming a key enabler of flexible living across the city.
But the financial mechanism here, the money behind this massive acquisition spree, that's what really sets us apart. Let's look at the institutional backing.
Absolutely. The stability of long-term returns from high occupancy rates in the extended stay sector is highly appealing.
So we're seeing major institutional investors like PGM Real Estate.
A huge player.
Right, actively acquiring hotel assets, specifically for this purpose, for conversion into rental housing.
And when a global firm like PGM, which manages massive amounts of capital, validates this specific asset class, it confirms the business model is robust and probably scalable globally.
So stepping back, what's the core rationale? Why is Hong Kong's rental market so secure right now that they're willing to bet billions on it?
We can point to two strong interconnected factors that address that why it matters question for you.
Okay.
First is just undeniable demographics and strong structural rental demand. Hong Kong is a financial hub. Talent has to cycle in constantly, and these high-value professionals, they demand instant quality accommodation.
And the second factor is usually the political or regulatory environment, isn't it?
It is, and this is where the strategy aligns perfectly. The trend is strongly supported by explicit government initiatives aimed at attracting foreign talent.
This isn't just passive support.
No, the government is actively recruiting professionals globally. But let me introduce a complexity here. Is there a regulatory risk? I mean, isn't buying up hotels potentially harming the long-term tourism infrastructure?
That's a fair point. But what we're really seeing is an implicit policy decision, right? The priority is shifting. If you're actively recruiting skilled labor, you have to have housing ready for them.
The need for immediate quality housing for talent seems to outweigh the temporary need for more hotel rooms.
Exactly.
And the mechanism is simple. Many of these new talent schemes provide temporary residency permits or visas, which often preclude an immediate property purchase.
So it effectively locks this new talent cohort into the high-quality rental sector for the first year or two.
Yes, it creates this concentrated structural demand boost for the exact kind of flexible serviced accommodation that Weave Living is creating.
That linkage is crucial. The government policy isn't just saying, come here, it's structurally generating a demand for rentals.
And the conversion strategy perfectly meets this demand with immediate supply. It's a flawless strategic alignment.
They're positioned not just as property owners, but as a crucial pillar in the city's ability to execute its talent strategy.
And the fact that they're converting existing stock means they can deliver this solution almost immediately. They capture that market share while traditional supply development just lags behind.
It's a really powerful combination. You've got available supply that can be quickly repurposed, you have massive institutional capital flowing in, and you have structural demand guaranteed by both market dynamics and government policy.
It's the perfect storm. They are fulfilling a core necessity for the modern mobile professional and the corporate team.
And that strategic need to provide these flexible, ready-to-move-into extended stay solutions is only going to intensify as global corporate mobility increases.
Not going away.
This has been an incredibly deep dive into the changing face of Hong Kong real estate. Just to review the key takeaways for you. First, we saw the sheer massive volume of acquisition, nearly 800 rooms pending. It demonstrates aggressive, high-speed expansion.
All fueled by using existing infrastructure.
Second, we noted the crucial diversification across rental types, moving beyond the co-living niche into stabilized, institutional-friendly, multifamily and serviced apartments.
And finally, that strong endorsement from major institutional capital, which is fundamentally linked to strong market dynamics, all driven by these government initiatives to attract foreign talent. It's a remarkable case study in how to unlock latent value in real estate just by changing its purpose.
Absolutely. Thank you for joining us on this deep dive into how former hotels are swiftly becoming Hong Kong's new flexible housing stock.
And here is a final provocative thought for you to consider. This conversion success, it largely hinges on regulatory flexibility, the ability to switch a building from a hospitality code to a residential one pretty quickly. So how might this strategic model reshape other hyperdense metropolitan areas in Asia Pacific? Think about places like Tokyo, Seoul, or Sydney. If they were to actively streamline the regulatory hurdles like strict fire safety or zoning codes that currently prevent these rapid hotel to residential conversions, could solving that one bureaucratic friction point unlock billions in shadow housing inventory globally?